There's stuff that I disagree with him very strongly in here, but there's probably more that we actually agree on than disagree on. Part 2 of where I'm calling Graham out. I want to break this down because it's very important that you understand that real estate is local. And there may actually be a market where Graham is totally on point and the market has severe indicators pointing that it's going to crash. I'm just saying for our area, coastal Virginia, the indicators just don't point that it's going to crash. I think it's going to level off, but let's dive into the details a little bit more.
Now we got to talk about the most controversial topic from all of this, and that would be the rental market. Just recently, a Realtor.com analysis found that in metropolitan cities, rent increases have finally begun to slow down, and in some locations, even reverse as demand begins to subside.
Yep. Totally agree here. Again, like I said in the previous video, people are always evaluating the difference between renting and buying, regardless of interest rate, regardless of where housing prices are. If you're in today's decision, you're not looking at 10 years ago. Maybe you're saying, oh, grandma and grandpa bought their house for $40,000 and their interest rate was this. I can't believe I had a mortgage payment like that. But they are evaluating their dollars and how far they go today. What's interesting is the same chart that he's using from Realtor.com. If you actually go to their website and look at that, Virginia Beach is in the top 10 metro areas that favors buying over renting still today.
Even though I have fixed rate mortgages, my own cost has increased anywhere from 15 to 20% by higher property taxes, higher insurance, higher labor prices, and higher material costs. That cost has to come from somewhere, so either I subsidize those costs by paying out of pocket or it gets passed on to the tenant.
Yep, it's going to get passed on to the tenant. I'm telling you right now that even though probably something like half of the landlords across the nation are actually moms and dads that own their properties and they're not these big conglomerations, you know, when the prices of replacing the back deck, the water heater, so on and so forth, and doing those repairs has gone up 15%, those costs are going to get passed down to the tenant. That's just the unfortunate part. They're not going to just absorb that cost for you.
Most mom and pop landlords have no other choice but to raise rents accordingly, and just like any other business, the tenant pays more. That's why we've seen the rise of these evil landlord memes, when in reality, 77% of landlords are mom and pop owners. I know it's hard to feel sorry for someone who's fortunate enough to own a property to begin with, but the fact is, 43% of mom and pop landlords used to live in the home that they now rent, 26% plan to move back into the property at some point, and 30% are already in retirement years and rely on rental income to pay for their expenses.
That totally makes sense to me. Probably half of my clients are military. They come in, they buy a house, they move out of the area. Some of them are planning on coming back. This just checks the whole, yep, that's what I'm actually experiencing myself.
And as we're starting to see, rental prices have begun to stabilize, even though they're significantly higher than they were just 2 years ago.
Yeah, he's saying that they're stabilizing. My guess is that depending on where inflation goes, especially if interest rates continue to rise and start making that barrier to entry of buying more and more cost prohibitive, you're gonna see more and more people say, oh, well, I guess I could just go rent, and which is gonna do what but increase the demand side of the rental side of the market, which is going to continue to increase rental prices.
But enough about me. I think it's really important that we get as many different perspectives as possible. So I drove all the way to Los Angeles to meet with Jason Oppenheim to get his thoughts on the market and the direction we're headed.
Oh, there's so much to unpack there. Interest rates have slowed demand, certainly, especially in the lower price points. I've seen, and I think we're normally in probably 20 escrows at a time. We're probably in like 5 or 6 escrows right now. So
Jason operates in the hyper luxury market. So I agree with him that some of that is going to be less sensitive to interest rates. And like he just said, it's going to affect more of the lower price points because most people at those price points are taking out a mortgage. However, what I'm also seeing in the luxury side of the market is that it's kicking out a lot of people. At $1 million, the difference between 3% and 5.5% is probably somewhere in the range, depending on what you're putting down, $1,000 to maybe $1,300 a month. And so for someone who was looking at maybe jumping from a $500,000, $600,000, $700,000 property into a more luxury property, well, because the interest rates have risen so drastically, they're no longer considering that option, or there are less of those that are doing that.
How do you think sellers are approaching the market differently?
I think they're pricing more aggressively now. I think they're not as emboldened to come on the market and expect multiple offers. I think they're considering their first offers now and considering offers that are under the asking price.
Yeah, I'm definitely seeing this myself. One of the things I preach the gospel of is that there's the art and the science of selling real estate. The science is looking at the data, which I do a lot of. The art is, hey, this is some of the conversations I'm hearing over and over and over again with current buyers in the marketplace. And so even though, let's just say that the market data shows the exact same days on market, list price, contract ratio, months of inventory of, say, 2 years ago, because we are in a more trepidatious, or some people are a little bit more cautious market, people treat it differently, even though the data is exactly the same. And so I'm seeing buyers who are willing to be a little bit more patient, push a little bit harder on negotiation. I'm seeing sellers who are just nervous that they've missed the boat, or the house is not going to sell in the first weekend. And so they're compromising on what they would have if they'd just be a little bit more patient.
I think we're going to see just complacency in the marketplace for the next year or two. So prices will have stabilized. I think they'll just continue to stabilize. I don't think they'll go down, but I also don't think they'll go up. People were buying to buy. I was buying to buy, as in, for investment or what have you, or because interest rates were so low. I think right now people are realizing that sellers are realizing and buyers are realizing that they should buy or sell based on their own unique circumstances and whether it actually makes sense for them, as opposed to just trying to make an investment or a business decision.
I feel like I'm listening to an echo chamber here. I 100% agree with him. People are going to be more reasonable. They are not just waving money around. If you're at, like, let's say 2.5 or 2.75% interest rate, bidding the property up another $10,000, $20,000, or $30,000 was so minuscule when it came to, at certain price points, the increase in your monthly mortgage payment, that people were kind of throwing those numbers around without really thinking twice about them. Now that interest rates have risen so drastically, people take that and analyze that a little bit more critically.
But the reality is, this is what any realtor or long-term investor should want, is normalcy.
This is what I was talking about previously. It's not a buyer's market, seller's market, sky is falling. What we have gone is from an unbalanced market to a slightly more balanced market. We are still in a seller's market, like I have been preaching from the rooftops for the last 3 months. The reality is that just because we go from pegged out seller's market to slightly backed off does not mean that the sky is falling and everything is burning to the ground.
So overall, it's definitely apparent that we're beginning to stabilize and enter a new phase of the market that isn't just prices rise indefinitely. From what I could see, mortgage rates have begun to hold firm and even decline to 5%. Prices are increasing, albeit at a slower pace, and rental prices are only going up as much as a tenant can afford. In terms of the future of the market, though, I've said this before and I think it's worth repeating again. The Calculated Risk blog pointed out that we could be following a very similar trajectory to real estate prices in the 1970s, which were also plagued by rising prices, skyrocketing mortgage rates, and high inflation. But here's where things get interesting. During that time, home prices continued going higher in terms of a dollar amount, but real returns, when accounting for inflation, fell by 11% over 3 years, meaning home prices went up, but the net value declined.
Yes. But I think you're interpreting this wrong, Graham. The idea here is that real estate is a long-term game. It tends to follow along with inflation. If you track the Case-Shiller inflation-adjusted price index for housing, in general, it's been for like 150 years, 3.5%, right? When you buy real estate and hold on to it for a long period of time, in general, it is generally a safe bet. But when you day trade real estate like you were doing stocks, that's when you get yourself into trouble. People need to stop looking at the headlines and making emotional decisions and make tried and true decisions on real estate based on principles.
After all, median home prices are up 10.9% year over year, but inflation was 9.1%, meaning home prices only increased by 1.8% above inflation, which is completely in line with the historic average. That's pretty eye-opening, right? All of that is to say that inflation needs to be accounted for when comparing home values. And barring a complete meltdown of our entire economy, most likely home values are going to begin to normalize from here on out without prices just continuing to rise up indefinitely without merit.
So it's funny to me how Graham has this tendency to start off with kind of like inflammatory statements, but then he always kind of cools it off down at the end, which is kind of what I was anticipating because I pay attention to him on a regular occasion. So, hey man, I get where you're doing and I get where you're going there. I still totally respect you. There's just sometimes when you're doing some of these things, I just think that you're interpreting the data wrong or potentially kind of feeding the fire rather than, calming fears and getting people to really think about things rationally.